The modern relationship with money often begins in a quiet moment. It starts with confusion rather than a dramatic financial collapse. It usually happens early in the morning while standing in a kitchen. You might be waiting for coffee or sitting in a car. You open a banking application on your phone expecting a number. Instead, you see a figure significantly lower than your mental math. There is a specific sinking feeling that accompanies this realization. It is not panic exactly, but a heavy sense of friction. You scroll through the transaction history, scanning for a mistake. Perhaps a double charge or a fraudulent purchase was made. Usually, there is no villain to be found in the history. Instead, you see a series of small authorized transactions. A subscription renewal you forgot to cancel appears on the screen. A gas station visit or a grocery run cost more. Then you see the fees or interest charges applied overnight. The money is gone legally and procedurally correct in the app. You wonder how a substantial salary has evaporated so efficiently. This is not a failure of personal discipline or overspending. It is the result of a meticulously engineered environment. This system is designed to separate you from your capital. We grow up believing banks are neutral storage facilities for money. We are taught that a bank is a simple utility. You deposit your earnings for safekeeping in the bank's vault. The bank lends that money out to stimulate the economy. In exchange, you are provided with security and small interest. This mental model creates a sense of trust and partnership. We believe the bank wants us to prosper and grow. The bank projects stability through solid buildings and sleek applications. Their marketing speaks of partnership dreams and financial health. This belief is a dangerous illusion that obscures the business. For middle-income earners, the bank is actually a counterparty. A partner succeeds when you succeed in your financial life. A counterparty gains when you make a mistake or stumble. Modern banking relies on fee generation and revolving unsecured debt. A customer who pays in full is actually a cost center. The ideal customer earns steady income but lives on the edge. They trigger fees and interest charges with reliable frequency. Money is structured with an order of operations people ignore. The system processes payments faster than it processes your deposits. When you swipe a card, the hold is always instantaneous. When you deposit a check, the funds face a clearing period. This temporal gap creates a zone of vulnerability for the consumer. Your perceived balance and actual available balance are rarely identical. This discrepancy is exactly where the financial friction occurs. Algorithms predict your cash flow and offer credit when tight. They present these offers as safety nets for your account. These features function more like trap doors for the user. Every feature that makes spending easier removes the psychological pain. This removal of friction is a mechanism to increase velocity. The system is built so spending feels like doing nothing. When you hit a wall, the penalties are not proportional. A coffee purchase can trigger a massive $35 fee. This is a structural tax on those who are cash flow poor. Consider an individual carrying $5,000 in credit debt. This balance could be from a car repair or medical bill. The interest rate on this card is 24% annually. The bank sets the minimum monthly payment at a low threshold. This number is carefully calculated to feel manageable and small. Most of that payment is consumed by the accumulating interest. Only a small fraction actually reduces the principal debt balance. Paying only the minimum keeps you in debt for long periods. You end up paying thousands of dollars in interest alone. The bank converts your debt into a perpetual income stream. The minimum payment is the mathematical minimum to keep you trapped. This debt acts as a ball and chain, restricting your freedom. This dynamic shifts as you move through different life stages. In your 20s, the trap is often focused on account fees. The bank extracts value through monthly maintenance and overdraft fees. In your career, the bank wants to capture your interest payments. They offer home equity lines of credit or premium cards. The marketing shifts from avoiding fees to earning rewards points. Rewards points are the casino comps given to high rollers. To earn points, you must channel massive spend through them. They bet that a furnace will break or a job lost. The credit line suddenly becomes an interest-bearing debt trap. High earners are encouraged to view debt as leverage. They offer 0% interest, knowing many will fail to pay. This triggers retroactive interest on the entire original amount. The trap evolves into a complex labyrinth for the middle class. Most people succumb because they are exhausted by the system. The banking system has weaponized human psychology against the user. We seek immediate gratification and avoid any immediate pain. Using a credit card means you do not feel the loss. The emotional connection fades, but the debt remains on the bill. The complexity of terms and conditions serves as a fog. We accept terms because we have no viable alternative. The friction of switching banks is a logistical nightmare. Banks rely on this stickiness to keep you inert and quiet. We convince ourselves we can beat the house with points. Optimization fails when life gets messy or sickness occurs. A divorce or depression can collapse the optimization strategy. Banks wait for one moment of weakness to capitalize on you. The perfect way to keep you broke is through volunteering. They provide a smooth, paved road leading directly into a hole. The rocky, difficult path leads to true financial independence. Normalizing debt ensures a portion of your earnings is pre-allocated. They have turned the storage of money into consumption. You must stop viewing the bank as a helpful partner. The bank is a business selling an expensive product called money. Their incentives are diametrically opposed to your financial freedom. The minimum payment is a subscription fee to poverty. Overdraft protection is a predator waiting for a slip. The system is maintained by your participation and passivity.